Well, good morning, everyone. Thomas Montgomery with IIMFL and Smart Money Alliance. It's my pleasure to visit with you this morning. We get together with our distribution partners most weekdays at 8 o'clock a.m. Central, or a minute or so before, on this same Zoom webinar bridge. We talk about strategies, techniques, and have general training, and certainly we're here to answer your questions as well. Our model has evolved based upon the changes in the marketplace and the financial environment. We've really tried to simplify both how we work with our distribution partners and how you make money. Really, we have two types of distribution partners now. We have affiliates, free and easy to become an affiliate. Doesn't cost you a penny now or later. You can help others, help small businesses earn income. Just refer folks in. We'll take it from there and you get paid. And then we have our joint venture partners, our joint venture small business incubators. As of this recording on December 3rd, there's a total of 11 of those now and steadily growing. And that's where we're working with professionals like yourselves who are wanting to help small businesses, but be more involved. So you earn more, but you do more. Now, we have two agenda topics for today that I want to go through. First, we're going to talk a little bit about a slight tweak that we've made to our commercial address offering. So we'll talk about that. And then we're going to talk about week 3, what you do if you're mentoring a client in the third of the 4-week process. So we'll cover both of those this morning. Now, what you see on the screen, or you should see on the screen, I'm intended to share it with you. Let me know if you don't. Is a map that I didn't develop. It was developed by the Tax Foundation, and you can see Tax Foundation as of January 2020, and it talks about the difference in corporate income taxes by state. Why is this relevant? Well, especially if you're a joint venture incubator manager, and to a lesser extent if you're one of our affiliates, we are educators, right? And so what is commonly overlooked is where you domicile your business affects your money. It affects your profitability. And I don't know that there could be a better graphic example than looking at this. If you and I were sitting down with a group of entrepreneurs talking about starting a business and getting access to capital, that decision starts with, where do I want to domicile my business? Where do I want to form? Where do I want my business to be based? Well, a logical person would look at this map and say, I see that there's different corporate income tax rates in different states. Higher number equals more taxes and less profitability for me. So maybe I should consider a low tax state. Well, then we look a little deeper and we see these gray states, like what the heck? Texas, Nevada, Washington, Wyoming, South Dakota, and Ohio have no corporate income tax. I'm onto something here. So with our incubator model, in most cases, we're going to be setting up our incubators in one of these states, especially in Texas for some other benefits I'll talk about in a moment. You need to be able to overcome the illiteracy that some small business owners might say of, well, sure, the incubator concept sounds fine, or I need a commercial address, but I'm in Iowa. Why would I want to form my business in Texas? Well, Joe or Anthony or Barry or Bruce, you could form your business in Iowa, but guess what? Your corporate tax rate could be as high as 12%. Or if we need to pick a place to domicile, a place to form your business, why don't we consider maybe putting it in a state where there's zero corporate income tax? That's going to save you potentially, depending upon how profitable your business is, thousands or tens of thousands or more per year, right? So this is a strong reason of why in general, we're setting up incubators with Texas addresses because of this reason. Now, there's a couple other reasons too, isn't there? What you and I know is that there are different sources of capital, and we need to match the entrepreneur based upon their mitigating circumstances. We've talked about that many times before. But another layer to that is there are different sources of capital available in different geographic areas. And so what we know is that there's some sources of capital available here. So in addition to have 0% corporate income tax, which is a big deal, there are things like the Chapman Fund that are available. They're tax supported. So you couldn't be here or here or here or here or here, any of these other 49 states and get the Chapman Fund, because the Chapman Fund is tax supported here. So it's designed to help start and grow businesses here. The Chapman Fund is an example. It's a real example, but it's an example. So for instance, Tulsa, Oklahoma has a program that if you move to Tulsa, Oklahoma as a person unrelated to the business, they'll pay you literally $10,000 to move yourself and or your family to Tulsa, Oklahoma. That's a tax-based incentive to try to accomplish what they want, increase population. Well, what we know is we have access to the Chapman Fund here with our incubators in Texas that's not available elsewhere. And that's up to $250,000 to start or grow a business. So that's a big deal. And then also there's the workforce grant that provides 100% of the labor cost and taxes and workers' comp cost for eligible employers, again, subject to being in the right place. All right, so the change that I wanted to mention is with the standalone commercial address. What you and I know is you must have a commercial address if you want to build business credit off of your EIN. We can't have a residential address. A post office box isn't going to work. And if you have one of these fee for shared offices where you pay money, but they give you an office suite that's used by a bunch of other people, that's not credible enough either. We need a unique commercial address. And so that is why we launched the commercial address program. It previously required clients to pay a year upfront, $499.99 upfront. We split that 50-50 with you, our joint venture incubator partners. We've heard from many clients that they wanted to pay monthly, and so they can do either now. They can pay monthly, and of course, we split that 50-50 with you. So it's $600 a year to you. You get paid a little bit more, but it's spread over the year, or they can pay $499 up front. Still, the rest of this is all still the same. They'll have access to the Chapman Fund. They'll have access to the workforce grant. We will still help them build business credit up to $250,000 under their EIN. So the rest of the proposition's the same. I just wanted to bring to your attention that now we can help small businesses with a monthly pay. Now, why is this relevant to you? Number one, some clients aren't going to be ready or willing for the full incubator package, which includes the filing of the business entity, that includes the business phone number listed with directory assistance and the QuickBooks and the website and all of that. I mean, that's still the Cadillac program, if you will. It's still very much available, but some won't be ready for that or willing to do that. So this is your fallback position. For those of you, especially those of you that have life insurance licenses, this is the golden ticket, because this is going to help open the door with small business owners that are looking for capital. It meets one of the key credibility factors that they're typically missing, which is a unique business address. It helps them build out their business credit, and it creates a client relationship. Sure, you'll make $600 from the client, I understand, but more importantly, now you are a trusted advisor. You've assisted that small business in getting more credible. Certainly, then you could follow up with them and explore other ways that you could assist, which may include, of course, helping them with their asset protection, which may include a key person policy. So in summary, agenda item number one, wanted to bring your attention, you may have already known this, but the corporate income tax rates vary considerably from state to state. It's smart to form in a state where there is no corporate income tax. And then your address matters. It matters in types of capital you have access to, and that's why we're building most of the incubators out of Texas, because of unique funding sources like the Chapman Fund and like the workforce grant, which are referenced here. Okay, so that's agenda item number one. Just wanted to get you familiar with it. And again, we can provide you leads list of businesses that are home-based, either newly formed or existing, more mature businesses that you could reach out to or have your staff reach out to, and they would be a great audience for this, right? Who doesn't want to be more credible? Who doesn't want to access capital under their EIN? Who doesn't want affordability? Of course, everyone wants all of those things. You can provide that, and that can be the door opener. Okay, so now we need to move on. So give me just a second to share the screen again, and we're going to go over to our next topic, which is on mentoring clients. So you should now see the IIMFL website. So we can go over here to the home page, and we're going to go to the small business certification. So what we know is that if you're going to be mentoring small businesses throughout this week, we've been training you, preparing you to do that. On Monday, we had the training that reviewed the entire 4-week process that clients go through. So if they enroll in your incubator, they'll be going through this. If they just simply plug into the Access to Capital program, no upfront cost, guaranteed $100,000 capital raise, no minimum personal credit, no minimum time in business to participate, then they're going to go through this. So if you're an affiliate, you're referring in, you don't need to worry about implementation. Still good for you to know what happens. If you're a joint venture partner, then you or someone on your team is going to mentor. So on Monday, we talked about the entire process at a high level. Tuesday, we dug into week 1. On Wednesday, yesterday, we talked about week 2. Today, to no surprise, we're going to talk about week 3, and then tomorrow on Friday, we'll wrap it up. So some of you picked up on the fact that we actually conducted the personal financial statement here on week 2, and we taught you step by step how to help clients with that yesterday. Here, just keep in mind, this is a different word. It's similar. So some people say, hey, we're doing the same thing twice. No. So in week 3, they're going to get the financial management lesson. You can click on it and observe it here. It'll be emailed to them automatically. So this goes to them on day 1. This goes to them on day 7. This goes to them on day 14. This goes to them on day 21. So every 7 days, they automatically progress. And if you're mentoring clients, you should be having a Calendly appointment set up with them each week. So on week 3, what you're going to be focusing on is setting up their key person policy. So let's talk a little bit about that. So key person policies are a special type of life insurance that are designed to provide a collateral assignment. Well, why is that needed? Well, lenders, some require, many prefer, but it's always a good part, an essential part of a good loan package. It is to have, I worded that poorly. So some lenders require a collateral assignment. Some lenders prefer it. But regardless, it's always good to have as part of a loan package a key person policy. The key person policy serves a specific purpose. It includes the ability for a collateral assignment. What that means is that if the borrower should die while the loan is open, there's a balance outstanding, then there's a document where the lender doesn't become the beneficiary, but they do have contractual right to be paid first an amount equal to the outstanding balance. So let's say that you have a client and they got a $250,000 capital raise. And so we set up a $250,000 key person policy. That's going to be commissioned to you. And obviously you're going to make what, with our commission structure, you're going to make around $2,500 for that one policy. Now, over time, the client is paying down the loan to the bank or to the lender, so there's less and less of a principal balance. So let's say they pay down to $200,000, but they unexpectedly die. So the life insurance policy is for $250,000. The $200,000 that's still an open payable to the bank would be paid off the top, and the remaining $50,000 would then go to the beneficiary, which is typically the business itself. So hopefully and ideally, the business owner, in this case that just passed away, had prepared some succession planning of, okay, if I'm no longer around, who's going to take over the business, who's going to operate it. And so then whomever's taking over the business now has that loan paid off, which is a blessing, and also $50,000 of cash to be able to help operate off of. So that helps with succession planning, and it meets the lender's requirements and or preferences to make sure that they're not hoping that the small business owner had a plan that someone else is going to take over the business and it's going to still operate. Because what lenders know is often small business owners don't have a good succession plan, and what the entrepreneur brought to the table isn't easily replicated. And so there's less probability that that business will continue to prosper under unknown leadership. So the key person policy, the way that we set that up is we set that up with a term policy. We all know that there's term and then there's permanent policies. So you may very well, as you're doing a needs analysis with the client here in week 3, they may have a need for a variety of different types of life insurance products for asset protection and growth, and maybe they're looking for ways to save money without risk and minimize taxation. But separate from that, from our purpose here of the collateral assignment, it's going to be most prudent to use a term policy because it's going to be less expensive for the client. Now, the way that we set them up, though, is a return of premium called ROP. A return of premium policy is great. So if the borrower should die, then everything I described would happen, right? The lender would be paid off, the balance of the policy would be paid to the business, and whomever's taking over the business would have extra money to operate and no longer have that debt over their head. If they don't die with an ROP, return of premium, then the eligible premiums come back. They're refunded. So it's a very logical, affordable, easy option for small businesses. Now, some of you really like IULs, indexed universal life policies, and I know that you can make more commissions off of that. And if that's what the client's most suitable for, we won't get in your way. But typically what we should be setting up is a return of premium term policy. Now, the good news is we're dealing with a high enough volume that we can get you right about 100% contract through the carrier we're writing through. And so with that, you're making about $1 for dollar. So that's where that example came from. If it's a $2,500 annual premium, for example, then you're going to generate right around $2,500 of commission. So that's what you focus on week 3, is helping them get their collateral assignment set up. Now, again, the way that we're setting that up is, again, return a premium term policy with simplified underwriting. In the past, we were going through carriers that had very laborious and painful underwriting processes that were taking forever or not ever completed at all. We're not going to fall into that trap again. So again, we're using simplified issue. Literally takes about 5 minutes for the agent just to put the information in, and then we've got back office staff that takes care of the rest. So you're not chasing paperwork, and so you're making a great comp off of it, great commission off of it, with literally 5 to 10 minutes invested per client. As I mentioned in earlier training, when clients come aboard, before we actually start this 4-week process, we're collecting from them a company profile. Well, that company profile, frankly, has most, and that'll be shared with you because you're mentoring the client, that company profile has most of what you need to get that policy set up. So then when you're having that conversation with them, you already know their social, you already know their earned income, you already know their address, you know most of what you need to be able to get that policy submitted. Simplified underwriting, and we've got staff now that'll take care of chasing anything that's needed, so you can submit it in and spend very little time with much better comp. So if you decide to become a joint venture partner, or you are a joint venture partner like Robert's asking, so then we'll send over the appointment paperwork. We'll get that to you. It's very simple. You'll return to us the entire packet, all pages and the W-9, so we know where the money is going to be paid to for the commissions, and then you'll be paid directly for these commissions off of these policies. Now, I know there's a few questions regarding that. Anthony's asking, well, what happens if the client is uninsurable? Well, that can happen. And I'm a great example. I'm a cancer survivor. So we applied for and received an SBA loan a couple years ago, not the whole PPP thing, but a true SBA loan a few years ago. And I'm a cancer survivor. Guess what? Typically, that makes you uninsurable. But there are some ways that we can work to get policies written for this type of purpose. But there will be some people, and so I was able to get a policy, by the way. But the point is, there's going to be some people that are truly uninsurable, and so we can work around that. But that's going to be the minority of cases. 7 out of 10, 8 out of 10, 9 out of 10 of the clients will be able to get insured. And if not, we can work around that. So don't let that be an obstacle. Thank you, Anthony, for that question. Joseph's asking, well, what happens if I'm not life insurance licensed? Well, you do not have to be a life insurance licensed agent to run a joint venture incubator. That's not a requirement. It's not a requirement. So if you're not life insurance licensed, then we'll have someone else write the policy. Now, it's my opinion that that's not ideal, because now you've got some third party talking to them, not the same person that's built a relationship, built trust, built familiarity. But if that needs to be done, then that needs to be done, and that's fine. So no, you do not have, Joseph, you do not have to be a life insurance agent to be a joint venture incubator partner to mentor clients. But obviously, if you're not licensed, then you're not going to be able to sell the policy because of state laws. Okay. Who else has questions on week 3's topic? Because again, on Monday, we talked about the entire sequence at a high level. Tuesday, we talked about week 1. Wednesday, we talked about week 2. And all these trainings are available. I'll show you where they're at. So they're a little bit hidden, but we can go up here to careers. And there's several YouTube trainings, but you'll see that mentoring week 1 is where we trained. So this was Tuesday's training. Week 2 was Wednesday's training, and then we'll add Thursday and Friday underneath. So you can go, if you missed any of the trainings, you can go to IIMFL website, careers, and then there's YouTube. If you want even more training, it's not on the menu bar, I don't think, but you can type in the super secret domain, a URL, IIMFL training, and then there's a ton, my screen's not refreshing, but there's a ton of training from past lessons if you really want to take a deep dive into training. The ones at the top have to do with being a joint venture partner. So there's 1, 2, 3, 4, 5, 6, 7 there at this time. So EJ's got a question. EJ's one of our joint venture incubator partners. So yes, if you have an agent that you want, let's go back to write the policies, that's fine, EJ. Let's get a call with them. Let's get them plugged in. Let's get the paperwork done. So that way we have shared economic incentives and we can better manage the process. So that's not a problem. Just let me know. All right, so let's see what other questions anyone has. EJ says great. Yeah, and we mentioned before on the entrepreneurial ecosystem training, and so that's probably, let's see if that made it on the career page. If not, it'll be on the training page. But we talked about, how to develop leads from other business to business professionals, CPAs and business bankers and so forth. Well, certainly as you're running a joint venture incubator, if I were you, I'd be reaching out to every licensed insurance agent that I could, and I would be bringing them in underneath your incubator as a financial literacy educator. So they're involved with you. You can have them either just sell the policies, or you could actually have them, of course, generate leads. You could have them actually do the mentoring through the 4-week process. But the more financial literacy educators that you have under your incubator, the better. And some of the easiest to attract will be insurance agents, because you're still in the revenue stream, right? These are your clients, you're controlling it. But now all of a sudden you can provide those insurance agents at no cost to them a steady stream of policies to write. And there's a lot of insurance agents that are not writing the number of policies they'd like because they don't have the leads. Well, you and I can solve that quickly. So I digress a bit, but that's a best practice, is to, underneath your incubator, to develop a team of financial literacy educators that are doing one of the following. Maybe they're out educating and teaching. Maybe they're doing the mentoring. Maybe they're just writing the policies. It depends upon how you want to allocate the workload. But the bottom line is, bringing insurance agents under your incubator is smart, smart, smart. And those people typically have a good business development mindset, and they may already have some small business relationships that they can bring to the table quickly. And home-based businesses, Robert asked about that, and that's right. So, we have the lead source of pretty much, I don't want to exaggerate, but pretty much every business in the United States: LLCs, C Corps, S Corps, DBAs. We can filter, and I think we demonstrated this once, we can filter off of if they're home-based or not, which it doesn't mean that they're all of a sudden a warm lead, but it just means they're somewhat pre-qualified, right? It's someone that started a business of one of those formats, and they're working out of their home, according at least to public records. And so they probably would be fairly receptive to the proposition that you and I have, which is, at least let us help you access capital with no upfront cost, guaranteed $100,000 capital raise. If you need a commercial address to access capital under your EIN, hey, we can help you with that. And it's now low, priced affordable at less than $100 a month. Or if you want a turnkey option, we can plug you in fully into our incubator, where we're providing a shell corp if you need it. We're providing the business phone, the website, the QuickBooks, and the entire package. So that is good. Now, there's a question that, who had yesterday? Someone had the question yesterday. I don't remember who asked it, but the question is, okay, if you have financial literacy educators under your incubator, how do you pay them? And the answer to that is, it's up to you. Now, when I said that, the person didn't like it. They felt it wasn't descriptive enough. So here's what I would do. If your financial literacy educators that are under your incubator are life insurance licensed, I'd say, hey, we'll work together. Let's go out and help small businesses. And you know what? We'll have you write the policies. You'll be able to mentor the clients through the 4 weeks, which isn't much, right? It's 15 minutes a week on average. And through that process, you'll be able to write the policy. And that's going to be enough, I think, to get them, because now they have a method to reach out to small businesses and write 10, 20, 30, 40, 50 policies a month. So if they're life insurance licensed, for many of them, just the opportunity to write the policy will be enough compensation for them. If they're not life insurance licensed, what we've been talking about is simply, and this is recommendation, it's up to you, just offer them a flat $100. So every client that you refer into my joint venture incubator, if they become a client, then I'll pay you $100 for that. And keep it simple. So you're not paying some point of the capital raise and everything else, just a flat $100. And you're making over $6,000 per client. So to pay out $100 to get not a lead, but to get a new client is a slam dunk. Now, again, you could do it much differently. You could piggyback off of the workforce grant, put people on W-2 salaries and all of that. But the simple way to pay financial literacy educators, again, is as follows. If they're life insurance licensed, we'll train them, we'll support them under your incubator, not taking you out of the picture. They're not competing with you, and let them do the mentoring and write the policy. If they're not life insurance licensed, have them just refer in and offer to pay them a flat fee based upon clients that enroll, and typically $100 will do the trick. Okay, so let's see what other questions you all have before we wrap it up here. All right, there's a couple comments I don't fully follow, but I'm getting ready to run out the door. So hopefully let's recap and make sure we accomplish what we set out to do today, and then we'll get back again tomorrow morning. So we talked about two things. We talked about where a business owner forms a business matters. It's going to affect their profitability because of state income taxes. It's going to also impact their access to capital because there are some taxing districts in some areas that have funding programs that's not available if the business isn't domiciled or based there. And then we moved over and talked about the second topic, which is the third week of mentoring. If you're an affiliate, frankly, this doesn't matter. You just know what's going on behind the scenes. If you are a joint venture incubator manager, then you need to care about this a lot because you or someone on your team, under your incubator that you're managing and overseeing is going to do the mentoring weekly. And week 3 is the profitable part, right? During week 1, we've helped them build their business plan and we started to build a relationship with them. Week 2, we put together their personal financial statement. We continue to create value and trust. And then now all of a sudden it's like, okay, now let's go ahead and get your collateral assignment set up. If you went and just tried to sell an insurance policy to someone without going through the first couple weeks, you'd have much more resistance because you wouldn't have the trust, the relationship, and the relevance like we have here. So again, if you know any life insurance agents, invite them to be a financial literacy educator under your incubator. Doesn't cost them anything. There's no background check. There's no nonsense. They're going to be working through you, under you. The money's flowing through you. You control how they're paid. But now essentially what you're getting, quite frankly, is a free lead generating source because they'll go out and help spread the word. And then secondly, you're getting free labor to help implement because typically they'll be excited, they'll be ecstatic, not all, but many will be, to do the mentoring because they're going to be able to monetize that doing the financial needs analysis leading into the key person policy. All right, well, we covered a lot and I'm running out the door here. So if you need me, you can call me directly or we'll be back tomorrow morning. Thanks, everyone. Have a great day.